Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. All the comments and subscribers, I greatly appreciate it. This week up, Twitter. We're going to take a look at their historical financials, 9 years of it. We're going to figure out what kind of free cash flow they generate, what kind of free cash flow they can generate in the future, and we're going to figure out what we think we could earn by buying the stock today and holding it over a long term. Ready? Let's get to work. Now, before we dive into Twitter here, I want to review the 5 key attributes that we look for at all stocks before we consider an investment. Number 1, top line revenue growth. You've got to have it. Number 2, earnings growth. I want to see EBITDA, enterprise level earnings growing. Strong free cash flow, number 3. Low debt, number 4. And a well-priced stock. Well-priced, we use enterprise value to EBITDA, but it could be free cash flow yield. It's kind of a combination of those that produces a return that's above market. That's what we want to see. All right, let's dive into Twitter here. I've got 9 years of historical financial. Please read the 10K. It's only 90 some odd pages. Fiscal year ends December 31st, so this is the 2020 version of the 10K. And I highly recommend you read it. It's only 90 pages. So let's take a look and see what we get. 2013, we can pick up revenue of $665 million and growing to $3.7 billion. Pretty steady, 10% annual growth rate, which is I like to see. It does vary a little bit, and I think back in 16, 17, Jack Dorsey wasn't really involved. He had stepped aside. They kind of called him back and really got back in the game. And as a result, they're really starting to monetize their user base, right? They've come out recently with a new, I think it's Twitter Blue, a new paid subscription service. And they're going to start monetizing their subscribers more so than they already do, which I like. And I think that's going to give them a real boost going forward. So does the market, by the way. That's why the stock's up. Let's figure out, if we buy it now, how much of that growth is already baked into the forecast. So revenue is growing 10% annually. It's an annual CAGR. That checks the box. EBITDA, they are profitable, which I really like to say. They've been profitable for many, many years. So it's not like they're just a growth story that can actually make money. These guys make money and grow top-line revenue, which is a great business. They're also kind of the only person in that game of live, constant news feed. I really like that as a business model. So EBITDA's been all over the place, a little shaky in here, and that's okay. I mean, revenue's growing. I would like to see this more in line, but there's some reasons for it. It's kind of back and forth a little bit. Overall, I think I'm going to give them a pass because revenue is growing, and that's what they're doing. They're putting their cash into R&D. That R&D is driving this number up. So I'm not going to give them unduly burden my reliance on EBITDA, at least its growth rate, because they're putting a lot of money in R&D, which I believe is growing this top line number. So long as this number is positive, over the long term, I still feel it's growing, so I'm going to give them the check the box there. Let's take a look at debt and debt and enterprise value. So long-term debt, they do have debt. However, they have a tremendous amount of cash on the balance sheet. And that's not even all the cash. They have cash in the cash line, but then they have cash in the short-term investment line, which is what we use for excess cash. And they have $5.5 billion of cash sitting in their bank account that they really have no use for. And that cash is actually more than debt, so their debt is zero, which I like. You and I both know that I love companies with zero debt. That's good. Also, cash balance growing on the balance sheet means that they're doing something right. Their business model is satisfying customer demand, giving them enough cash to reinvest in their business, and leaving cash left over at the end of the day, which is why this number is growing. And I like that. That's it's very hard to fake cash. And if you have cash in the bank account, auditors can go call JP Morgan and say, hey, how much cash does Twitter have in the checking account? They tell them, oh, okay, great. And the auditors sign off for it. It's a third-party check, much better than, say, asset values in the bank balance sheet, a goodwill value in the balance sheet, which management basically create a forecast model. It's what I do, create a forecast model, discount it back. Here, auditors, here's my value of what I think my assets are worth, at least goodwill and other intangible assets like that. That is much easier to, much harder to pin down, I'll say it that way. But cash held in a bank account held by JP Morgan is easy to verify, and I really like that. Sorry, got on a tangent, but I love cash, you know that. Market cap, shares outstanding times price, enterprise value. I add up debt plus market cap, less shares, less cash, gives me enterprise value. And enterprise value is the true value, the total value of what the business is worth. And here, what do we have? We've got a company that's gone from 35 billion to 42 billion. So it's kind of gone a round trip here. We had 35 and then it fell, low of $10 billion. That is an absolute steal. And I have to share, like that is low. And I remember looking at that number many, many years ago and thinking, boy, that's a great buy. I got distracted and didn't do it, unfortunately. But back when Jack Dorsey was just coming back into the business, I had a feeling that he was really going to move that needle for us. But I didn't get in. I still don't own the shares, but it has done remarkably well. Enterprise value up 400% from the last couple years, from $10 billion to $41 billion. Wow, good for them. Market multiple, EBITDA market multiple. It looks like it's fairly constant. It fluctuates, low of 18. That's a great little buy in there. 44 is kind of the high. Averages, that average doesn't make any sense because it's negative. But in there, what's that average? That average is 32 times. So 32 times, probably a little expensive for a company that is growing at about 10% annual. I think people are really relying on the new subscription service that they're trying to come out with, or the new monetization that they're trying to do. Let's go take a look at free cash flow. All right, here's Twitter's free cash flow. And again, I'm picking up the cash flow from operations, $1 million. That's a low number, but it definitely grew from there. As they got bigger, it's grown to about $1 billion in free cash flow, $1.3 billion every single year. And that patterning follows the pattern of EBITDA, which is a nice small little accounting check that I like to see. It looks like they're doing it. And what we're seeing is they're actually generating cash, which is rare for some of these tech growth companies. I'd love to see a company that generates free cash flow. CapEx, less cash. It's a pretty decent margin, at least here. That's roughly not quite a third, but maybe 40% or so of this number. Which still leaves plenty of cash to pass through. So I think when they grow, when they scale, they should generate a lot of cash, because this CapEx number is not going to grow in line, or at least the same line as CFO. If you remember FedEx, we did I think last week. FedEx CapEx is going to grow in line with CFO. Software business, it doesn't happen that way. So then you've got debt payments, kind of a wash here. They don't have any debt, so I'm gonna just gloss through that. Free cash flow per share, strong, growing. I like to see that. Debt, shares outstanding, shares. Here they are issuing shares. When you look at their cash flow statement in the 10K, they have a very, very large share-based compensation. It's almost $400 million every single year. It's a monster number. In my opinion, it's far too high for the amount of cash they have on their balance sheet. They should be paying their employees in cash or buying back those shares right away with the cash they have, because they're allowing that shareholder comp to dilute their shares, which I don't like. They should pay the employees in cash or just buy the stock back from them. But that's where this 2% is coming from. And I'm going to assume that's going to continue going forward, because Jack Dorsey has like a super majority on stock for voting. I don't think they're going to be changing their policy anytime soon. So I'm going to assume that dilution is going to continue. Free cash flow per share is fine. Price and a yield. Yield 2.6. 9 was probably a little too high. That's abnormal. It's probably a large debt inflow. Yeah, here you go. Large debt inflow. Abnormal. The market says abnormal. I'm not going to adjust the yield. Let the yield spike, and then it comes back down because the share price didn't change. Okay, so kind of checks our boxes. Let's take a look quickly. Top line revenue growth, good. EBITDA growth, it's good. Low debt, they have none. Strong free cash flow, yes. Let's see how the forecast looks. And then with the forecast, we can figure out if it's well priced or not. Okay, so to forecast this business, I'm going to do something a little different. It's so hard to forecast a growth company. So what I did is I looked at the Q2 earnings that they just recently released. And it's a monster earnings beat. And it's a materially different growth rate than they've been experiencing in the past. They are up 50% year to year when they look at the first half of 2021 against the first half of 2020. So if I look at historical growth rates, revenue, which is here, 15, 14, 7, kind of declining, not great. And then what they just minted, I've assumed an annual rate of 40%. Again, 6 months, they grew 6 months relative to last 6 months, last fiscal year, 50%. So I think they're going to print a pretty nice number for 2021. I'm giving it a 40% growth rate. I also think that the new monetization focus, the new subscription service, they're going to roll out probably a lot of other kind of bolt-ons to that. I think that gives them another growth trajectory that's long-term. And when I look at what the analysts are assuming for Twitter out 10 years or so, these are roughly in line with what I think the market is looking at. So it's got a 40% and it bring it down over time as they scale, that they run out of runway essentially because they get bigger and bigger. It becomes harder to grow. So they go from $5 billion to 15, $16 billion of top line revenue growth. I also look at margins. They're currently at a 23% EBITDA margin. If I look at something like Facebook has a 40% EBITDA margin. Whew, man, that's a fantastic EBITDA margin. But I assumed a 30% because I don't exactly know how they're going to take their business. I want to be somewhat conservative. So I gave them a 30% EBITDA margin, which is still strong. I mean, but in the software world, the online world, you can see really, really high. Facebook is probably an outlier, is one of the highest. So 30% I think is fair. That gives EBITDA as $5.1 billion out 10 years. And what I tried to do is just continue this on to figure out what free cash flow yield would be. So I took EBITDA, I subtracted about 15% for taxes and other that they're going to have to spend to come up with a CFO estimate. Then CFO, I gave CapEx, I called it $1 billion roughly, and I grew it at 10% a year over time to give a widening scale. Remember, CapEx is not going to scale in the same way that cash flow will. So cash flow can grow at a nice margin with revenue and with margin expansion, but then CapEx that they have to put back is not going to grow as fast. So you get growing faster free cash flow. So it goes from $21 million to $2 billion of free cash flow out a decade from now. And again, the shares outstanding, I'm assuming continued 2% share dilution out for a couple years, and then I did just 1% out long term to give me a free cash flow per share forecast targeting about $2.18 long term. So if I plug those into our EBITDA forecast, just literally copying it down, I assigned the 20 times EBITDA market multiple to this $5 billion. Again, because growth is moderating, but it still will have a subscription base, which is very attractive. Still has some growth. So I give a 20 times handle, which I think is a conservative number. It gives me $107 billion market cap. Divide by fully diluted shares, by future forecasts, assuming all the dilution, gives me a $117 price target. Same logic with the free cash flow. Copy the free cash flow I just forecast down. I gave it a 3% yield. Give me a $72 price target. So now where are we? We've got two price estimates. We've got one based on the free cash flow yield. We've got another one based on an EBITDA market multiple. So these two is a pretty wide range, $72 versus $117. I'll split the difference, call it $95 long term. I can currently buy all the shares I want in the market for $63 a share. If I put this into an IRR forecast, what do I get? I'm in for 63, I get a cash flow, I'm out for 95, and it gives me a 6% IRR. Now that IRR is not high enough for me to do this. I like the stock, but I think what's going on is they announced the Blue Twitter subscription platform. When I look at what analysts are forecasting, they're forecasting essentially this forecast. So I think the market is saying, hey, analysts, what do you think? And it's like, this is a reasonable estimate. And they're like, okay, fine. I will bid up the stock price against what I believe the analyst is saying as truth. And the higher price point means that buying into the analyst forecast today is now a lower number. In other words, we missed the boat. We should have been buying it a couple years ago, kind of when Jack Dorsey was coming back into the fold because we knew he was going to shake things up. Right now, it looks like that future is completely embedded in the stock price. So for me, I'm going to give it a meh. I can't give it a poor because I think it does meet all the safety criteria, but 6% is not at all good enough for me. So let's review our 5 key attributes. Number 1, top line revenue growth. Yes, it's doing it. EBITDA growth, absolutely it's there. Strong free cash flow, you better believe it. I like that cash flow. Low debt is 0. And well priced, no, it's not well priced because this IRR for me is too low for the business. And when you look at the growth story here, historically, growth kind of, 10% on average here, 25, 14, 7, and declining. They get one good year so far, which is shaping up to be 40%. Again, 50% halfway through the year. I'm giving 40% for the full year. But then even these years are still higher than this. So there's some risk here that this growth is a one-time blip, or it takes longer to fully realize this entire schedule than reality, right? They did decline revenue in a particular year. I have 0 declines here. This is always growth. So I think there's some risk there. And I would say, as much as I like the stock and would like to buy it, I'll try to pick it up when it's cheaper. Here's the distribution. So $63 a share at 6% IRR. Assuming nothing changes here, this is the same forecast. If I buy it at a more expensive price, it falls. If it gets cheaper, I don't know, less than $50 a share, it'd be a really, really great buy. So this is my forecast and valuation for Twitter. If you like doing this kind of work, or you're interested in learning how to do it yourself, or there's terms that I cover that you didn't understand, check my website out, cashflowinvestingpro.com, where I teach a course. I provide you a template, this template, so you can fill it in. I teach you how to read 10Ks, how to pull out the information, how to build a forecast, and how to think about building a portfolio for yourself. The feedback I've received on the class is that it has tremendous value, that it's absolutely worth doing, and I suggest you do it. My name is Cameron Stewart. This is Rational Investing. This was Twitter and my thoughts. Tell me what you want to see next in the comments down below. There's some amazing stock recommendations down below. I don't have time to get all of them, but they're fantastic. Hit that subscribe button if you like what you see, and I'll talk to you next week. Thank you very much. Bye-bye.